All right, so you've sent us a ton of stuff to read, and, well, we're going to make it easy for you.
Yeah, cutting through all that noise to get to the good stuff.
Exactly. We're calling this a deep dive. You're with us on the deep dive.
A deep dive into, well, whatever you want to learn.
And today, we're diving headfirst into real estate. Investing in real estate.
Big topic, lots of questions. Especially if you're just getting started.
We're using How to Buy Your First Investment Property as our guide.
Yeah, great book. Lots of practical advice.
It really does walk you through everything, from finding those hidden gem properties to, making sure you don't get ripped off when it comes to financing.
Yeah, all the way to closing the deal. The whole 9 yards.
Our mission today is to give you those foundational principles, like the building blocks you need.
Exactly. Those aha moments, but without overwhelming you with every little detail.
Practical steps. That's what we're going for. So first things first, you got to find the right property. The book talks about this rich dad philosophy, and it's all about finding those properties that can give you, well, cash flow.
Right. Money in your pocket every month.
But also potential for growth. That's the appreciation part.
And that's a key difference between a value investor and a speculator, right? The value investor is looking at both.
Yeah, that's steady income and the possibility of the property going up in value over time.
Versus the speculator who's basically just hoping for a quick buck, a price jump.
So if you're just starting out, the book has pretty straightforward advice, actually.
Stay local.
Yeah, get to know an area really, really well, spend time there, drive around, walk, even bike, get a feel for the neighborhoods.
The book even talks about Kim Kiyosaki, the author's wife, actually jogging through neighborhoods she was considering investing in.
It's about becoming familiar, right?
Yeah.
Knowing the market inside and out.
You'll start to notice those potential deals, maybe even hear about properties before they hit the market.
Give yourself an edge. And remember that 100-10-3-1 rule. It's a good reality check.
You might look at 100 properties before you even make an offer on 10, right?
Of those 10, maybe 3 will accept your offer, and you'll likely end up buying just one.
It's a process. It takes time to find the right one.
Once you've found an area you like, the next step is to figure out what kind of property you're actually looking for.
Right. And as we said before, cash flow and appreciation are key, but the book goes a bit deeper.
They recommend looking for up-and-coming areas, places that are on the verge of, positive change.
Not just residential either. Pay attention to the commercial development in the area.
New businesses popping up, construction projects, those are all signs of growth.
And for beginners, they say, start small.
Yes, single-family homes, a duplex, maybe even a 3-unit building.
Get your feet wet, learn the ropes.
You might make some mistakes, but on a smaller scale. And positive cash flow can help with that.
Acts as a bit of a buffer, right?
If a pipe bursts or something, that regular income can help cover the unexpected costs. And sticking to your local area makes it so much easier to manage everything.
Keep a close eye on your investment. The goal here is to find those properties that generate positive cash flow right away.
Yeah, find those steady earners and hold on to them. Now, how do you even know what you can afford?
Good question. The book gives this simple rule of thumb. Take the amount you're planning for your down payment and multiply it by 10. That's your starting point, your price range. And then look at properties 20 to 30% above and below that number.
But they do say don't get totally hung up on the price.
If a deal looks promising, there might be creative financing solutions.
Now, what about fixer-uppers? A lot of folks wonder about those.
Your book suggests they can be good for beginners, but
Look,
focus on those that need minor cosmetic work.
stuff like landscaping, paint, maybe new appliances, these kinds of things can make a huge difference.
They can really boost the value without breaking the bank.
But the book does warn about older properties. They might mean more than just a fresh coat of paint. So, you've picked your area, you know what you're looking for.
Time to actually find these properties.
Hit the pavement.
Seriously, they emphasize physically exploring those neighborhoods. Look for those for sale signs, see which real estate agents are working in the area.
Talk to the people who live there. They often have valuable insights.
Online resources are great too. Check those real estate websites, get a feel for the prices and rental rates.
The book even suggests contacting the local Chamber of Commerce.
Find out about any development plans in the works, public and private projects.
And understand the local laws, those zoning regulations. They can really impact a property's potential. So, you found some properties you like. How do you know if it's actually a good deal?
That's where the pro forma comes in. It's a tool to evaluate your potential return on investment.
It's basically a projection, what you might earn and what you might spend. Different from a cash flow statement that just looks at the past.
Make it a habit to ask for pro formas from the real estate agents. But remember, they're often designed to make the property look good.
They might be overly optimistic about potential rental income or underestimate expenses. So what are we looking for in these pro formas?
Well, first off, you'll see the price, either the asking price or what you expect to pay.
And then there's the cash-on-cash return. Think of this as the annual return you'd make on the cash you've invested. Your annual cash flow divided by your down payment.
Right. And then the CAP rate?
The capitalization rate.
Yeah.
This is the return on the property itself. No financing considered. It helps you compare different properties on a level playing field.
Then you'll see the unit mix. How many units are there and what types? Studios, one bedrooms, two bedrooms.
Then you'll have your gross income.
The total potential income from all those units.
Assuming they're all rented out.
Yeah.
But then, of course, you'll have a vacancy rate.
The percentage of units that are likely to be empty at any given time.
There could also be some other income listed. Stuff like parking fees, laundry facilities, things like that. And then, of course, we have those operating expenses.
All the costs of running the property, like utilities, maintenance, property management fees.
You'll also see reserves.
Money set aside for future repairs, that new roof down the line. So if you subtract the total operating expenses from your gross income, you get your net operating income, or NOI.
And then you've got your debt service, your mortgage payments, basically. Principal and interest. What's left over after all of that? That's your cash flow.
Your bottom line. And the pro forma might also mention if there's any existing financing you could take over, assumable financing. Or if the seller might be willing to finance part of the deal themselves, owner financing.
The book emphasizes that the more pro formas you review, the better you'll get at spotting the red flags and the diamonds in the rough.
Absolutely. You start to see the patterns. Location, as always, is key.
Don't just look at the price tag, but also the price per unit, price per square foot. Compare those to similar properties in the area. Is the neighborhood on the up and up?
Unit mix is important too. Does it fit the needs of the area? Families, students, young professionals.
And remember, older properties can mean higher repair costs down the line.
Scrutinize that vacancy rate. A high vacancy rate could be a red flag, but it could also be an opportunity. Maybe you have a strategy to attract more tenants.
Or maybe those high operating expenses mean there's room for improvement in the property's management. Assumable financing with a good interest rate, that could be a huge plus.
A higher cash-on-cash return is usually what you're aiming for, but a slightly lower one might be okay if there are other appealing factors.
Like strong potential for appreciation. And if you really want to get down to the nitty-gritty, the book talks about using the Rich Dad's Real Estate Evaluator.
Plug those numbers in from the pro forma, play around with different scenarios. What if rents go up? What if you can reduce vacancies?
See how it affects your cash flow, your overall return. It's all about working those numbers.
The next step is to identify the upside, the potential.
Where can you increase income, lower expenses, make improvements that boost the property's value?
Maybe there's a simple solution to a problem that's been dragging the property down. Poor management, deferred maintenance. Fix it, and you increase the value.
So on the financial side, you might look at raising rents, carefully of course, lowering those vacancy rates, adding income streams.
Things like coin-operated laundry machines, vending machines. Find those creative ways to generate extra cash. And look for ways to cut expenses.
Can you get tenants to pay for their own utilities? Appeal that property tax assessment. Shop around for better insurance.
Assumable financing can be a real advantage, as can owner financing, where the seller acts as the bank. Think about those amenities, too. Are they really adding value? Would it make more sense to convert that swimming pool into storage units?
When it comes to physical improvements, you might consider adding more units, converting existing space, even changing the property's use altogether.
Short-term rentals to long-term rentals, for example, but always, always check those zoning laws. They can make or break a deal.
Look into any city development plans that might impact the area. And don't forget about those potential city grants for improvements. So you've crunched the numbers, you've spotted the potential. Time to make an offer.
And be decisive.
Don't get stuck in analysis paralysis.
If you see a good deal, move on it.
Ask questions. Get as much information as you can from the seller, the agent, the property manager.
But remember, you don't need to know absolutely everything right now. The really deep dive comes during due diligence.
After your offer's been accepted. And that's where contingencies come in. Conditions that need to be met for the deal to go through.
They protect you, the buyer.
So let's say you make an offer. What happens next? The seller could accept it outright.
Great. On to due diligence.
They could reject it.
Bummer. But you can always try again with a revised offer,
Or they might counter.
which means more negotiation. Back and forth, usually in writing.
Once you both agree on a price and terms, you move forward to due diligence. Now, when you're writing your offer, there are some important things to consider.
Like how you're going to hold title to the property. Through an LLC, perhaps.
Don't assume anything. Spell out exactly what's included. That chandelier, the refrigerator. Put it in writing.
And include that earnest money deposit. Shows you're serious.
Make sure that legal description of the property is spot on, no mistakes. And simply stating how you plan to finance the purchase isn't the same as having a financing contingency.
It's worth considering asking the seller to cover a home warranty.
Provide some peace of mind coverage for those major appliances and systems. Now, let's talk more about contingencies. The book really stresses that they're there to protect you.
They give you the option to back out of the deal or renegotiate if something's not right.
Some common contingencies include reviewing the financials, inspecting the property, making sure the title is clear,
Securing financing, getting your partner's approval if you have one.
and you can get really specific too, like a pool inspection, making sure all the units are rent-ready, confirming that the parking lot meets all the regulations.
Just remember those deadlines for releasing the contingencies.
So, you've made your offer, the seller's countered, and now you're in negotiations. The book offers some great tips for navigating this stage.
Keep your eye on the prize, which is cash flow.
And set your maximum price before you even start talking. Try to find out what the seller originally paid.
There are some psychological tactics too, like rounding up your offer slightly. It might seem more appealing.
Patience is key. And listen to the seller. You might learn something valuable.
Be ready to compromise, but stick to your priorities.
And don't get emotionally attached. Be willing to walk away if the deal isn't right for you.
Always treat the seller with respect. You never know, they might have other deals down the line.
All right, so you've got that accepted offer. Now it's time for due diligence.
This is where the real investigation begins.
Remember, everything up to this point has been based on estimates. Now you get to really dig in.
Use a checklist, stay organized.
Involve your team, your lawyer, your accountant, any experts you need. Two crucial areas the book highlights are the property inspection and the appraisal.
Even if you're handy, it's worth getting a professional inspector, especially for larger properties.
And the appraisal is important for both you and the lender. It confirms the property's value. You can usually hire your own appraiser if you want a second opinion. The book stresses that due diligence are two very important words in real estate. Don't skip this step.
So, you've done your due diligence, you're happy with what you found, now it's time to talk financing.
One of the great things about real estate investing is leverage. Using other people's money to build your wealth. This section of the book gets into the nitty-gritty of getting that financing,
And they start by defining a lot of the key terms.
like adjustable rate mortgage, amortization, APR, assumable loan, all that good stuff. You really need to understand the lingo to make sense of it all.
They also point out that you have more options than just traditional banks.
When it comes to conventional loans, there are a few main types. The 30-year fixed-rate mortgage, predictable payments, the option to make extra payments without penalty. But the interest rates might be higher for investment properties.
Then there's the 15-year fixed rate. Lower interest rates, lower total interest paid over the life of the loan, but higher monthly payments.
And adjustable rate mortgages, those ARMs.
Potentially lower initial payments, which can make qualifying easier, but those rates can go up. When it comes to finding a lender, shop around.
Compare interest rates, those points they charge, and the lender's reputation.
Start your search early before you even have a property in mind. Talk to your real estate agent, ask friends for recommendations, look online, check those industry websites. Now, how do you know if you'll even qualify for a loan?
Lenders look at three main things: your income, your credit history, and the property itself, the collateral. They want to see that you have enough stable income to cover your debts.
For investment properties, you'll usually need at least a 20% down payment. And that credit history, it's crucial. A good credit score gives you more options. They'll look at your payment history, how much debt you have, your employment history.
Get a copy of your credit report, make sure it's accurate, and the property itself has to be worth enough to cover the loan, which is where the appraisal comes in. The book also goes through everything you'll need to provide when you apply for a loan: your financial information, employment history, everything. But what if you don't qualify for a traditional loan?
There are alternatives. Government-backed loans like FHA and VA loans.
These are mainly for owner-occupied properties, but you could potentially buy a home with an FHA or VA loan, live in it for a while, then rent it out. FHA loans have lower interest rates, lower down payments, easier qualifying.
VA loans are even better, no down payment required in many cases, but you have to be a veteran or eligible dependent.
When there are assumable loans.
Taking over the seller's existing mortgage could be a great deal if the interest rate is favorable.
And finally, there's owner financing. The seller becomes the lender. Can be great if you can work out the terms, but get everything in writing and consult a lawyer.
They wrap up the financing section by defining some closing-related terms.
Okay, you've made it to the final step, closing the deal. This is where you sign all the papers and the property officially becomes yours.
HUD, the Department of Housing and Urban Development, has guidelines for closings. Check their website. They have lots of resources.
Before you get to the closing table, make sure you've got everything in order. Pick your closing agent, make sure your financing is finalized, review those closing costs.
Know what you need to bring, get those surveys and inspections done, review the contract one last time, get title insurance, homeowner's insurance,
And do a final walkthrough of the property. Make sure everything's as it should be. Closing costs are the fees and expenses both the buyer and seller pay to finalize the transaction.
The book goes through the typical costs: title search, insurance, attorney fees, real estate commission, all that.
The closing meeting itself should be pretty straightforward if you've done your prep work. Make sure you have all the documents, your certified check, and your real estate agent there with you. The seller will bring their paperwork, the keys, any warranties, and you might need to prorate some expenses.
Things like property taxes, mortgage interest, rent. Divide them fairly between the buyer and seller for the portion of the month that each owns the property.
You might want to bring your lawyer to the closing, especially if it's a complex deal.
Review the closing documents carefully before you sign. Make sure the deed is correct, all logins are removed, you have all the tenant information, the prorations are accurate, all contingencies are removed, and you have any warranties that are coming with the property.
They'll go over the settlement statement with you, which shows the breakdown of all the costs.
Don't be afraid to ask questions. It's a lot to take in, we know.
So there you have it, a deep dive into buying your first investment property. We covered finding the right property, analyzing the numbers, securing financing, and closing the deal.
A solid foundation for getting started.
Now, the author talks about how fear of failure can hold a lot of people back. What's one small step you can take today to overcome that fear and move closer to your real estate goals? Maybe it's researching off-market deals or learning more about different investment strategies. The more you know, the more confident you'll be. So keep learning, keep exploring, and good luck on your real estate journey.
Absolutely. And remember, we're here to help you dive deeper into any topic you're interested in. So send us your reading lists and we'll break it all down for you. Until next time, happy investing.
Happy investing.
See you next time.
See ya.